This ORB approach quickly became my favorite after I found it and modified to suit my trading style. It just works really well for me.
What is he doing?
He's beginning to believe.
Hey traders, today we're exploring a powerful strategy using two TradingView indicators to profit from opening range breakouts, or ORB for short. This video will provide a thorough walkthrough covering everything from A to Z, so be sure to stick around until the end to get a complete understanding. Before we get into the specifics, let's discuss what ORB is and why it's popular among day traders. The ORB strategy is based on the idea that the initial trading range of a session often sets the tone for the rest of the day. Traders watch for breakouts from this range, betting that the momentum will continue in the breakout direction. There are several variations of the ORB strategy: fixed time, volume-based, multiple time frame. Let's review them before getting into the main part. Fixed time ORB. This approach uses a predetermined time period, typically the first 15-30 minutes of trading, to establish the opening range. Here's how it works. The high and low prices during this set period define the range. Traders watch for breakouts above the high for long trades, or below the low for short trades. Entry triggers occur when price moves a certain distance beyond the range, a specific number of ticks or percentage. Stop losses are often placed on the opposite side of the range. This method is popular due to its simplicity and consistency, but it may not always capture the most significant price movements of the day. Volume-based ORB. This strategy incorporates volume analysis alongside price action for stronger trade confirmations. Traders monitor volume during the formation of the opening range. A valid breakout should be accompanied by an increase in volume. Low-volume breakouts are treated with caution, as they may lead to false signals. This method can help filter out weak breakouts, potentially improving trade quality. Multiple time frame ORB. This advanced approach combines different time frames for more robust signals. Traders might use a longer time frame, like daily or weekly, to determine the overall trend. An intermediate time frame, say hourly, could be used to identify key support and resistance levels. The shortest time frame, for example, 5 or 15 minutes, is then used for the actual ORB trading. Entries are taken when signals align across multiple time frames. This method provides a more comprehensive market view, but requires more analysis and can be more complex to execute. Okay, let's get into something a bit different today. We're going to look at an interesting twist on the ORB strategy using two indicators that are publicly available on TradingView. The first indicator helps us define our opening range clearly and has some useful extra features. Let's add it to our chart. It's called ORB Breakout by Or. This indicator plots the high and low of a specific time, which we can use to define our opening range. Here's what it does. Allows you to set a specific hour and minute to mark your range. Adjusts for different time zones. Plots the high and low as crosshairs on your chart. Generates buy and sell signals based on breakouts from this range. The ORB breakout indicator can be used on its own, following a simple rule set. If a candle breaks the high of the opening range and the next candle breaks the high of that candle, a buy signal is generated when the third candle breaks the high of the second candle. This method is straightforward. You set your time zone, define your opening range, and wait for the signal. However, while simple, it may not always be the most reliable approach. Relying solely on these entries can be risky. Without considering the broader market context, we might find ourselves trading against the prevailing trend, which is generally not advisable. To mitigate this risk, we need to incorporate a trend filter. Our second indicator is called MA Ribbon R2 by Just Uncle L, and you can find it on TradingView as well. Let's add it to our chart. This particular indicator offers various types of moving averages, but for our strategy, we'll focus on using the exponential moving averages, or EMAs. Here's why this tool is particularly useful for our ORB strategy. It provides a more detailed view of the trend's strength and direction. Instead of just one line, we get multiple lines that help us see the trend more clearly. The spacing between the EMAs can show us how strong the trend is. When the lines are spread apart, it usually means the trend is strong. When they're close together, the trend might be weakening. These EMA lines often act as levels where price might bounce or reverse. This can be really helpful for finding potential entry or exit points. The ribbon is particularly good at showing when a trend might be changing, especially in choppy or sideways markets where a single moving average might give unclear signals. For this particular strategy, we set the fast EMA length to 10 and slow EMA to 20. Note: disable the built-in buy and sell signals of the high and low indicator to avoid confusion. However, if you find them visually helpful, you can keep them enabled. Now, let's break down the strategy step by step. The high and low indicator sets our range at market open, establishing key levels for potential breakouts. When the price breaks above the high for long trades or below the low for short trades, it signals a potential shift in market sentiment and momentum. For long trades, the ribbon should slope upwards with faster EMAs above slower ones. For short trades, the ribbon should slope downwards with faster EMAs below slower ones. After the breakout, wait for the price to pull back to the ribbon, often representing a retest of the broken range level. This allows for entry at a more favorable price. If the price bounces off the ribbon, showing a clear rejection of lower prices for long trades or higher prices for short trades, this is your entry signal. Additional considerations: look for increased volume on the initial breakout and decreased volume on the pullback. The further you move from the opening range, the less relevant it becomes. Use higher time frame charts to confirm the overall trend. There's no one-size-fits-all approach to stop losses and profit taking. It depends on your trading style and overall strategy. By following this systematic approach, you can potentially identify high-probability trades that align with both short-term momentum and broader market trends. Remember, no strategy is perfect, so proper risk management is crucial. Always use stop losses and never risk more than you can afford to lose. In our next video, we'll explore backtesting results and how to fine-tune the strategy for various market conditions. Thanks for watching, and best of luck with your trading.